In 1929, two men looked at the same economy through the same set of market data. One made $700 million. The other lost every cent he owned. The difference was their focus. One man followed the public story of rising prices. The other followed a specific 5-stage sequence. This pattern of behavior has appeared before every major financial crash for over a century. Most people ignore these signals until the market breaks, leaving the public entirely blindsided by the sudden loss of value. Understanding the mechanics of a collapse requires looking past the daily news cycle and tracking the 5 stages as they develop. Stage 1 is defined by a quiet warning. Markets continue to rise, and to the average observer, everything looks completely normal. Beneath that surface, leverage is actually falling. Borrowed money, the fuel for market growth, is being pulled out of the system. The market is running on empty at this point, coasting forward on momentum that no longer has a foundation. This leads into stage 2, where the environment shifts through a period of tightening. Central banks raise interest rates, making credit expensive and much harder for the public to acquire. Prices generally hold steady during this phase, but the system begins to experience immense, invisible pressure. These early phases are particularly dangerous because they encourage complacency while the structural integrity of the market rots. Stage 3 introduces instability, as the pressure from high interest rates finally forces its way to the surface. The market begins experiencing massive swings in both directions, which observers mistake for typical volatility. These erratic movements signify that the structural system is actively fracturing under the immense weight of expensive money. A single negative event then acts as a trigger for stage 4, causing the sharp drop the public recognizes as a crash. By the time this event makes news, the most informed capital has already left the market. This brings us to stage 5. As asset prices collapse, those holding cash begin to buy everything at a discount. This phase facilitates a mechanical transfer of wealth from those who followed the story to those who understood the sequence. By mapping our current economy onto this historical sequence, we can see exactly where we stand today. Interest rates have already moved higher, and liquidity has tightened, confirming that the first 2 stages are complete. We are now seeing the same 3% daily swings that preceded the 1929 and 2008 breaks, indicating that we are currently navigating stage 3. The global economy is suspended in the gap between this current instability and the final trigger. Because the trigger event has not yet occurred, a temporary window remains open to reposition capital. This sequence acts as a mechanical countdown. Once the 4th stage begins, the opportunity to move liquidity disappears. Your position when the trigger arrives determines whether you are providing the liquidity or receiving the assets.